Today on Open Exam Prep, we will cover the Federal Reserve System for the SIE exam. This is a crucial topic because the Fed's actions have a widespread impact on the economy and the financial markets. Let's start with the basic structure of the Federal Reserve, often just called the Fed. It's the central bank of the United States, but it's not just one bank in Washington, D.C. It was designed with a decentralized structure to represent the economic interests of different regions across the country. At the top, you have the Board of Governors, based in Washington, D.C. This board consists of 7 members who are appointed by the President and confirmed by the Senate for long, 14-year terms to insulate them from short-term political pressure. Below the board, the system is composed of 12 regional Federal Reserve banks located in major cities like New York, San Francisco, and Atlanta. These regional banks are the operating arms of the central bank, supervising local banks and helping to implement monetary policy. Now, what is the Fed actually trying to accomplish? This brings us to its famous dual mandate, which is a very testable concept. The Federal Reserve Act tasks the Fed with pursuing 2 primary goals: maximum employment and stable prices. Maximum employment doesn't mean a 0% unemployment rate, which is impossible. Instead, it refers to the highest level of employment the economy can sustain while keeping inflation in check. Stable prices essentially means controlling inflation. The Fed generally interprets this as an average inflation rate of 2% over time. Think of the Fed as trying to keep the economic engine from running too hot, which causes high inflation, or too cold, which leads to high unemployment. The dual mandate is a balancing act. Actions taken to boost employment could risk higher inflation, and actions to fight inflation could slow down the economy and increase unemployment. So, who makes the decisions to perform this balancing act? This is the job of the Federal Open Market Committee, or the FOMC. The SIE exam loves to ask about the FOMC's role and composition. The committee is made up of 12 voting members, all 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York, and 4 of the other 11 regional bank presidents, who serve on a 1-year rotating basis. The FOMC meets approximately 8 times a year to decide the direction of monetary policy. Their main tool is controlling the federal funds rate, which is the interest rate that banks charge each other for overnight loans to meet their reserve requirements. By buying or selling government securities in the open market, known as open market operations, the FOMC can increase or decrease the money supply available to banks, which influences the federal funds rate and, consequently, other interest rates throughout the economy. On the exam, you'll need to distinguish the Fed's actions from other government policies. A classic trap is confusing monetary policy with fiscal policy. Remember, monetary policy is the Fed's domain, involving the money supply and interest rates. Fiscal policy is controlled by Congress and the President and involves government spending and taxation. If you see a question about combating a recession, the Fed's monetary response would be to lower interest rates by buying securities, while the fiscal response would be to cut taxes or increase government spending. To help you remember the Fed's core mission, use this simple phrase: the Fed uses its MAP to steer the economy. M stands for maximum employment, and P stands for stable prices. The A in MAP can stand for AND. The FOMC is the one reading this map and using its tools, primarily open market operations, to navigate. So, when you see a question about the Fed's goals, think MAP, maximum employment, and stable prices.